The second half of 2026 market outlook. How can you capture opportunities while navigating through the risk in the market? And I would like to begin this session with a very quick question for all of you. Now, how many of you here you think that today's world feel much more uncertain than it did say 5-6 years ago? Give me a quick show of hands, please. You feel that the world is very volatile, very uncertain, a lot of things to look at. Oh, okay, thank you, about 50% of you guys. And it's normal. Let me tell you, it's totally understandable. Why? Because every other day, we are being flooded with new headlines. You see headlines about artificial intelligence, right? How it's transforming or disrupting some industries. You see the ongoing geopolitical tensions. There is also the rising competition between US, China, these two giants. And not just that, inflation concerns also, interest rate increasing. And you know, what's the scariest part of all this is that this list that you see here on the slide is not all. In fact, I've only listed the most recent concerns on the top of the mind of investors. But there are many others, and the list, to be honest, is never ending. There will always be something for us to be very concerned about, to worry about, right? And that's why people feel that the world today, the market today feels much more uncertain than it did. And you know, every time when I go for events, physical events, when I get to speak to some retail investors on the ground, a lot of them like to ask me questions like, hey, when do you think the next recession is going to be? You think now, right, with high inflation, interest rate going to increase again, is it a good time to invest or not? Or you know, you see this US, China are always trying to compete with one another, so who's going to win? Or you know, when will China overtake US and so on? So I always get questions like this. So today I'm going to try something different. Now, instead of me answering all these questions, I want you guys to try and answer it yourself. Okay? So I'm going to go around and find some volunteers, okay, to answer the question. Okay, how about this lady over here? Okay, how do I address you? Xing Yan, okay. So let me ask you a question. Make a guess. How high do you think the US Fed rate can increase up to? Any guesses? Oh, now it's 3.5 to 3.75% region.
Maybe 5?
Maybe 5%. Oh, wow, very scary. Okay, next, how about this gentleman over here? How do I address you?
Adrian.
Okay, so when do you think China can finally overtake US in tech leadership? Is it 5 years later, 10 years later, or next year?
I don't know if it can, because US has like companies like Google and Amazon, which are worldwide, and China maybe not so much.
China maybe not so much. So you think there will never be a day like this, is it?
I think that they will be able to compete, but I don't think that China will have the same reach as like a Google.
Okay, thank you. Let me pick one more. Okay, how about this gentleman over here? Just make a guess. When do you think the Iran war will end? Because you know, every other day Trump say we are finishing things already, but he has been saying this for very long. Any guesses?
No idea. But,
no idea.
But probably in 2 months' time, I don't know.
In 2 months' time. Yeah. Okay, thank you. So I decided to try this activity to show you this. Now the point I'm trying to make is this: actually, none of us really know the answer. Not me, not you, not the YouTubers you see online, not the economists, not the central banks even. They also don't know. How high can interest rate go up to? When can China finally overtake US? All right, will it happen? Or when will the war end? You know, these are things that we don't know. But you know, the good news is this: today's successful investing doesn't mean to say I need to know when exactly China will catch up with US, or how high will the interest rate be, then I can invest well. Now, we don't need to know all this exact future outcome. Instead, it's about understanding each of the theme, and then how do you want to position your portfolio accordingly. Of course, when we talk about investing, positioning portfolio, nothing is 100% one. Okay, so nothing you do can make sure 100% you will win money, you won't lose money. There's nothing like that. If there is, you can share with me after this session, okay? Yeah, but this is the point I'm trying to share with all of you, right? And that's why today, I'm going to talk about these 3 big themes. Number 1, artificial intelligence. Second, the US, China, and AI tech race. and finally inflation and geopolitical tensions, right? So that you can walk out of this room having more idea about what's happening in the world about these three themes, what are some of the opportunities and also the risk that you will be exposed to when you're investing in any of these themes, right? So starting off the first one, artificial intelligence. I think AI is one of the hottest topic that people are all looking at, right? So yesterday when I talked about AI, everyone laughed, semiconductor, everyone knows, right? Yeah, so AI, when we talk about AI, what is the first company or the top company that comes to your mind? Any company when you talk about artificial intelligence, the first company that comes to your mind? Nvidia, I hear Nvidia, thank you. Yeah, or is it I put Nvidia picture over here trying to lead you to answer Nvidia? Okay, yeah, so by the way, Nvidia has just released its earnings just last month in May for first quarter of 2027, and again it was a standout quarter. But what caught our attention was not just about how much revenue has increased, profits has increased, but about this deliberate change. So there was a deliberate change in the way that Nvidia now reports its revenue. And we do think that it does tell us where artificial intelligence, AI, could be headed next in time to come. So what is this change about? Now let's take a look, okay? So previously, under the previous disclosure, how they disclose their revenue is this. Nvidia separates its revenue, it breaks it down by what it sells. So you can see under data center, you have compute, networking, then gaming, professional visualization, automotive, and so on, okay? But now, in the latest disclosure, it is disclosing revenue based on who is buying. So what do I mean by who is buying? If you focus on the part on data center, then you notice that we have a hyperscale and we have this ACIE, which stands for AI, Clouds, Industrial, and Enterprise. So now these are who is buying from Nvidia. Okay, so to understand this further, I'm going to dive deeper into hyperscale and this AI, clouds, industrial and enterprise sub-segments, what they are, okay? So basically, if you take a look at hyperscale, I think you guys probably know what is hyperscale, or you already see the news, you will know. Yeah, so they are usually referring to the world's largest tech companies, names like Amazon, Meta, Alphabet, those who are operating massive data centers at global scales. So this is a group of customers that historically we know them that they are Nvidia's largest customer profile. Okay, so this one, I'm sure most of us here, you probably know about it, okay? But what about the other new segment, the AI, cloud, industrial, and enterprise? What is this segment about? So this segment is actually much more diverse. They have a broad range of customers under this segment. Firstly, we have the AI native cloud providers, those where they build specifically around GPU computing. And then we also have the industrial companies, those who do manufacturing, logistics. They are deploying now AI into their operations. Now, but aside from manufacturing, logistics sites, other types of enterprises, large enterprises, they also want to start embedding and run AI using on their own on-premise infrastructure. For example, you think of financial institutions like banks, healthcare companies, telecommunications, and so on. And finally, also the sovereign AI initiatives. That means governments, nations, they also want to build national AI infrastructure for a very simple reason, economic benefit, and of course, national security. So now all this diverse group of buyers, they are all grouped under this same sub-segment now. So that's why we say they have changed the way that they disclose their revenue only for this latest quarter that has just been reported. Now, and what's most interesting is that the revenue contribution from the hyperscale and this new segment is about 50-50. So if you take a look at the numbers, a little bit small, but you can see 37 something, right? Both start with a 37. Yeah, so it's a 50-50 revenue contribution. And we do think that this does signal the next wave of AI adoption is already underway. Because why? Why do they want to, do this kind of disclosure now? In the past, when people are looking at AI, all they are looking at is how much money the big tech are spending in terms of their capital expenditure. Names like Microsoft, Amazon. So we look at news like this. But now, what we are seeing is that the growth in AI upcoming could be driven by a more diverse group of buyers, such as the AI native cloud providers, the sovereign AI clouds, enterprises, and so on. So that could be, the next leg of growth moving forward. It's not just only about the big tech companies. And this brings me to the next point, where we have the next key milestone, which is also the transition from AI training to AI inference. Now, before I dive into that, let us just do a very quick, understanding of the terms. Training, inference, what does it mean? So basically, when you talk about AI training, is where I feed the AI model with a lot of data sets so that they can go and do their learning. So if I give you a real world example, think of, say, hospital. To train, it means to say I need to give the model many thousands of medical images so that they can understand, okay, this one means something is wrong, that one means clear, nothing wrong with this patient, and so on, okay? Now, what about inference? Inference is the next stage. So after the AI has the data set in their brain, okay, what they do next is they need to go and use it, apply it to solve real world problems. For example, now, because the model already know what are images that show that there is something wrong, and versus some images that show that the patient doesn't have any illnesses. Now they can do analysis on their own. I can give you a new X-ray, you can help me to see and flag out any potential abnormalities. So basically that's what inference means. So at the very start, the early growth of Nvidia was largely driven by the demand for its GPUs for training the AI models. But moving forward, the industry is increasingly moving towards inference, where the trained AI models now they have to go and solve real world problems so that you can be capable, right? And that's where people talk about AI agents. You probably heard about AI agents, right? So AI agents at some point, right, we want them to be able to solve problems. When the customer asks questions, they can solve. I don't need human intervention, right? And that's the future that we want to work towards to, where Nvidia, they believe that by then, in the future, we could have billions of AI agents, not just millions, but billions of AI agents, it could be created. So we believe that the bigger story today is actually lying in the enterprise adoption. So it's not just only looking at the hyperscalers, but once the enterprise starts to adopt it, it could unlock new AI native business model that now still don't have one. So a lot of things could change in the future, right? So that's the next wave of adoption for AI. Now, so speaking about artificial intelligence, the second thing that we need to look at is the race between US and China. Because very often when you're talking about technology, artificial intelligence, people are always asking, hey, is US winning it or is China winning it? Or who is getting ahead now, right? So this is a question that I'm sure is also on all of your minds today. So we're going to answer this today for you now, and this is my view. So the way we see it is that next time when you see me, don't ask me this question again, who is winning it? Because I believe that we shouldn't be framing this as like a binary competition. Meaning to say it's not either US win or it's China win, but they can both exist together at the same time. And the reason why is because the AI landscape is very complex, right? So today investors, as an investor, retail investor, what I can do is I can potentially invest in what US does well. And I can also invest in what China does well. So together, then that puts my portfolio to be in a more resilient, better position. Now, to understand this better, let me explain to you why do I say it that way. The reason is because US and China, they do possess very different structural advantages. Now, so what are the advantages that they have? Let's look at US first, okay? So for US, the first advantage that they have is they dominate in the core AI infrastructure. So US is home to the world's most advanced and powerful semiconductors. That's why we have names like Nvidia, right? And it's not just only about semiconductors. Now, when you talk about AI, what you need is also the cloud infrastructure. So for cloud computing, do you guys know who are the top 3 players for cloud computing? Number 1 is? Amazon, yeah, Amazon. And then you have Microsoft, right? Yeah, and then you have Google. Then after the 4th one, if I'm not wrong, is Alibaba. Okay, so they are the top 3. They already capture a very huge market share of the global cloud computing space. So this is what I mean by they dominate in the AI infrastructure side. Now, so that is one structural advantage that they benefit from. But something else that many investors overlook is that actually US also can potentially benefit from very powerful enterprise AI adoption cycle. Now, why? Because many of the largest international companies are from where? From the United States. Think of companies like Coca-Cola, Walmart, McDonald's, I just named a few only. These are the largest enterprises in the world, right? And they are coming from the US. So the moment when all these enterprises start to adopt higher usage of AI within the enterprises, it's going to unlock a very powerful enterprise AI adoption cycle for US side. So that is the second structural advantage. Now let's hop over to China now. What about China? So what is China good at? Now, one thing that China is winning in is AI efficiency. In terms of looking at energy costs, they are able to enjoy much lower energy costs as compared to the US. And that is in part because over the years in the past, they have already been making a lot of massive investments in green energy, right, over the years. And now it's paying off. Right. So based on some research, if you see the chart over here, that is a research done about 2 years ago. So 2024, they were saying that both US and China, they are expected to double their data center electricity demand by 2030. So both double, but the critical difference is that this growth in the energy demand is unlikely going to be a constraint for China. Why? Because today, China generates more than twice as much electricity than the US. And it has also grown its total power generation by nearly 6% per year over the past decade. More than half of the growth comes from the clean energy sources. So that is the difference, and that's why their energy cost is actually lower. So that is what the China side is winning at. Now, aside from that, there's another thing that China is doing very well, which is that they have a very strong consumer-facing application and ecosystem. So those of you, if you go China, you know there are some apps you need to download one. Right? You don't download, you don't use, cannot survive there, right? Yeah. So, and those are what we always know as super apps, right? Yeah. So the super apps, they can do a lot of things. E-commerce, social, payment, travel booking, everything, a lot of things all done on the app, sometimes on the same app also. So that gives China a very significant head start because when this ecosystem, the consumer side, when they start to also deploy AI, it will have a very huge head start when it comes to deploying AI from the consumer level. So that is the structural advantage for the China side. Right? So as you can see, very different. So that's why if you ask me who is winning, is it US, is it China or not? The answer depends on which layer of the ecosystem, AI ecosystem that you are looking at, because they are good at different parts. And of course today, there are still a lot of things that's happening behind the scenes. Many of the important breakthroughs in the future, we still don't know them yet, because they're still doing it privately, right? Until they're released, that's when you know. So that's why as an investor, what we believe in is you don't need to, only bet on one. Yeah, it's not like now you are betting on soccer like that. I know you are watching World Cup, so it doesn't mean you just bet on one team only. But when it comes to investing, we want to build a portfolio whereby it's resilient, right? Whereby it can withstand the different kind of outcomes, right? So portfolio construction today matters more than ever than just simply making market prediction. When is this going to happen? How high is the interest rate going to be? When is the recession coming? It's much more important than just doing all these kind of guesses, right? So basically, when you're building a portfolio, you don't want to build a portfolio that only works if one outcome happens. So I can have outcome 1, 2, 3, 4, 5. If your portfolio only do well when outcome 1 happens, then there is too constrained, it's too limited. But rather, I want a portfolio whereby even if outcome 2, 3, 4 happens, it can still do reasonably well, okay? Because I am positioned in a way where I do diversify my bets, right? And aside from that, every position that you have in your portfolio, you need to make sure that the investment thesis is not supported just by only one pillar, but instead it should be supported by multiple pillars. Now, what do I mean by this? For example, today, you go and ask a lot of investors or your friends or colleagues, a lot of them will tell you, we should invest in AI now, because AI is the future. Now, you shouldn't invest in AI just because you have the mindset that AI is the future. Like that is not enough. Okay? What you need, in order for AI to be the future, what do you need? You need the infrastructure, you need the semiconductors, you need the cloud, right? You need the enterprise adoption and so on. So this is what I mean. The multiple pillars has to be there. Then your investment thesis will work out. It cannot be just because I hear that AI is the future. Everyone is looking at AI, then I buy. Then it's risky. Okay, you might turn out to be lucky, but not every time might be so lucky. Right? So that is from the portfolio construction point of view. Now, in addition, I would like to also share with you some portfolio construction strategies that you can think about on how to weather uncertainty. Basically, 3 things that you have to bear in mind. Firstly, you need to have cash that you can deploy from the sidelines. Now, I know that when you watch YouTube video, you read article, every time people will tell you, when you have free cash, you need to make sure you invest everything, immediately put it inside the market, because when you put it inside the market, it can work, then it can compound and build wealth for you. Okay, I wouldn't say that there's no truth to it. Yes, there is some truth to it, but I would say that it is more of a generalized mainstream advice. Now, today you need to remember that cash is not just dead money. Cash gives us option. When you have cash during times where there are good opportunities in the market, when it's very volatile, then you can do something. You can deploy it for your investment, right? To capitalize on those opportunities. But if you don't have cash, then there is nothing for you to do. So cash is not dead money actually. It allows us to maintain what I call a margin of safety. What do I mean by margin of safety? Today I bought this company or this ETF at this price, but if I have cash and if the market comes down, that is where I can still lower down my cost. If I have no cash, then there's nothing I can do. Alright, so cash is not useless in other words. Now secondly is we want to build a diversified portfolio that pays us from multiple investment income sources. So I know some of you here, maybe you are still very young, you think, I want to do growth investing only because it can grow my money faster. Dividend investing is too slow, it's too boring, it's for the retirees only. But that is not exactly true also. Okay, let me try and adjust my mic. Okay, yeah, that's not exactly true. Today, even if you are young, whether you are young, you are old, right, it's good to have investment income coming from different sources. Why? I give you a very good example. This year, 2026, at the start of the year, if you remember, the US market was coming down, right? So even names like Magnificent Seven also come down more than 20%. Google, Amazon, Microsoft, even worse, come down even more. Yeah. So during that point in time, while your portfolio might be seeing some drawdown from all this impact, if I still have, say, some dividend portfolio, then I can continue to collect dividends from the dividend portfolio. So this is what I mean by having multiple streams of investment income. Not just only from growth, I also have dividend and so on. So they have different purpose and they might move differently at different point in time. So this is to diversify and reduce reliance on just a single source of income for ourselves. Now thirdly, you have to maintain conviction in long-term structural themes while you stay away from all the short-lived fads. So there will always be trends, themes. Every time have one. It's nothing new, okay? But the most important thing is you have to do analysis and think, is this trend just a passing fad, or is it something that's here to stay, structural theme that's here to stay over the next decade and so. So for example, when we're looking at AI, personally, we do believe that it's not just a short-lived fad, it's something that's here to stay. But having said that, it's still in a very early stage. A lot of things AI cannot do yet. I know it's very powerful, but there's still a lot of limitations. A lot of things we cannot do yet. Yeah. So for example, enterprise adoption is still in the infancy stage. AI agents also only starting to proliferate. They cannot do much yet, still not good enough. So moving forward, if you are investing in AI theme, you can expect that there will still be a lot of volatilities when it comes to the tech players, right? Or any players that's related to AI. So investing successfully means to say you need to have the conviction. So if you believe that yes, this is the investment thesis that I have, but when there's volatility, do you have the conviction to still hold on to it or not? So that's the difference. So that is also part of your portfolio construction mindset that you need to have. And finally, for my third theme that I'm going to touch on is on inflation and the geopolitical tension. Okay, so if you are reading the news, right, you probably know that now we are looking at interest rate hike again. So not rate cut. Last year we were still talking about rate cut, right? And then slowly now move on to rate hike. So things are always changing, very, very fast changing. So the chart that you see on the right side of the slide, that is showing the current probabilities of the rate hike. And I just took it yesterday only, on 26th June. So right now, when is the earliest rate hike that we are expecting? It's in September, 16th September, okay, the next September FOMC meeting, and after which is expected, to be in that 3.75 to 4% region. Okay, Yeah, so earlier on, if you remember, we did a very quick exercise. We asked, how high do you think the interest rate can go up to? Again, this one is anyone guesses. But what is most important, of course, is that now you see with the interest rate coming up, then the rate sensitive sectors are again in focus. So who are the rate sensitive sectors? For example, one is REITs. Okay, so real estate investment trust, because they do have a higher level of leverage. And of course, aside from REITs, any type of company, any industry, as long as you are carrying higher level of debt, then yeah, when interest rate change, you will be affected more. Okay, and aside from that, we also have names like consumer discretionary companies, because people might tighten their wallet, they might not spend more, so that would then impact the consumer discretionary companies again. So no matter what, the most important thing is you have to think about risk management. So what do we mean by risk management? So focus on owning the higher quality businesses, and that's where you have to do your fundamental analysis, looking at the companies, whether they are actually doing well, they are good quality companies, do they have any competitive advantage or not? These are the kind of companies that you want to own. And then aside from it, when you buy, you also want to pay a good price, right, to buy these companies. So for us, what we do is we do this thing called technical analysis. We look at the stock charts. So by combining both, is actually helping us to do this thing called risk management, where you buy good companies, so the risk of losing money is lower, and then you buy at a better price, so again, your risk of losing money is lower. So basically everything is called risk management. Now, and when we talk about interest rate hike, talk about geopolitical tension, one thing that I think is a very timely example for us to reflect on is gold. Now, gold is something that a lot of people have been looking at over the last 1-2 years, because it has been doing very well, right? Last year, the year before, gold was up by a lot. And that's why naturally, this year when we have the Middle East tensions, right, a lot of people might think, if there is a war, then it's the best time to buy gold, right? Because people always say gold will do well during all this kind of war, conflicts, uncertainties, right? But what happened? You take a look at the box up grey color area, it actually didn't do well. Okay, so the lesson that we can learn from this, and it comes back time and again, is that a lot of people, they just look at what we call textbook knowledge on surface. So yes, maybe you know that gold tends to do well during the uncertainties, during geopolitical tensions, but then you also have to look at where are the prices at now. So in the back in last year, in fact early of this year also, the gold prices have been rallying up tremendously. So a lot of people, they just rush in to buy. But in the end, they found themselves sitting on losses. So what is the pitfall here? The pitfall here is that when you see that there is a narrative that sounds very convincing, the more convincing it sounds, often the more the market has already priced in. Now, it was really scary because at the start of the year, even the news was reporting about gold, because my mother at home, she was on the Chinese Channel 8 news at 6:30 p.m. So I will hear as well. So even news are reporting about gold, talking about price going up, everyone trying to buy gold, everything. So when you see that everywhere, everyone is talking about this narrative, that is where usually you want to be a little bit more careful. Because the more convincing it is, the more people are buying it, actually the more dangerous it is. The higher the chance that the price has already been priced in, the market is already near the peak. So you don't want to just go in and rush in and buy together just because the price keep going up. So this is what we mean by the risk of entering at that point is actually much higher. But unfortunately, most people don't think that way, because they think if it goes up, it will go up forever. But as you can see again, it doesn't go up forever. Even during war period, it can still come down. So that's a very good timely lesson that we should learn from there. Using gold as an example, in the future, things like this will still happen. It might not be gold, it might be another asset class, but all such kind of narratives have always been happening over the years in the financial markets.
Yes. I ask a question. Regarding gold, right? How do you determine whether or not it's actually appreciated substantially from like what you mentioned here?
Yeah.
Because gold is just a metal. There's no earnings. There's no backlog.
Exactly.
There's no modes. There's nothing to actually give like sort of a baseline to determine whether or not is it overvalued or undervalued.
Yes. Okay, thank you for your question. Great question. So basically, gold is what we always say is a non-productive asset. That means to say it doesn't produce cash. You buy this amount of gold, 10 years later it's still this this mass of gold, right? So when it comes to gold, you cannot do anything like, you know, valuation or whatever. So basically, for that aspect, that's where we look at the charts to look at the price movement to identify any entry or exit. Okay, so that is one way for us to look at the price when it comes to buying asset like this. But having said that, I think you raised a good point. So actually for ourselves, those of you who have been following us for quite long, you will know that actually most of the time we prefer to invest in productive assets. So it means to say things like stocks, right? Because businesses are productive assets. So most of our money actually invested in all this area. Having said that, I know that some people want to have a small portion of their portfolio in gold because it's to act as a diversifier. I would say there's nothing wrong with that, but of course you don't want to have a situation where 100% of the whole portfolio is in gold. Then that is very, very risky. The concentration risk is high, that's one thing. And then secondly, you're putting all your money into a non-productive asset, right? And gold prices, when it's non-productive asset, it means to say that the prices are more speculative. It's based on perceived value, what people think this gold is worth now. And that's why it can go up very fast, it can come down fast as well. So that is the higher level of risk in an asset class like this, right? So thanks for your question. Okay, so before I end off my segment to pass it over, I would like to revisit the questions that I asked right at the start. Where will interest rate be next year? Will China overtake the US? When is it going to be? When will geopolitical tensions ease? Now the truth is no one have the answer to this with certainty. Not all of us, not myself, not any economists, YouTubers and so on. But the goal is this, remember, it's not to be able to predict every headline accurately. We don't need to do that. But what we want to do is we want to build a resilient, diversified portfolio that can perform well across a range of outcomes. And that also means to say you have to be patient, because sometimes I invest in this position, then how come I buy this? This is a good company, but the price never go up. It might take time for the recovery also, and nobody knows when it's going to happen. Even the CEO themselves don't know. Okay, so you have to be patient enough if you have the conviction, and of course it must be a proper investment thesis that you have done your proper research on. All right. So with that, I will now pass the time over to